So imagine you see a headline, a trader achieves a 12 times return on a stock in 2 years. Our first reaction would be admiration, and then we would try and learn more about their tactics. I remember searching this question when I would see wins or losses online on stock market returns, but Nassim Taleb and his framework, in my opinion, is one of the most robust when it comes to distinguishing luck or skill. His answer is that it's both, but luck takes the majority of the equation. Suppose you browse the cover of Forbes and you see profiles of self-made billionaires, tech founders, hedge fund wizards, biotech innovators. But what you don't see is the mass of ventures that are almost identically similar, but they never took headlines because they collapsed. This omission is not a small thing. It skews our perception of causality when it comes to luck or skill compared to their success. And we turn wins that are supposed to be explained via randomness to be apparent triumphs of design. Taleb labels this distortion as survivorship bias. To understand In Fooled by Randomness, his first book, he introduces the alternative history thought experiment. Imagine that each investor's career was accompanied by an invisible twin whose decisions mirror theirs, except that chance occasionally intervenes. When a freak market event wipes out one of them, only the surviving twin is represented in the data. Only the lucky investor gets immortalized. The unlucky twin gets removed from history, basically. The implication is very serious for investors. Our databases of winners are not neutral samples of excellence, but filtered records of those who happen to avoid failure. Consider the dot-com era of the late 1990s. If, for example, in 1999, you invested equally in 100 internet startups, two outcomes are possible. You backed Amazon or Google and saw your wealth multiply, or you backed Pets.com or Cosmo.com and lost everything. Nowadays, we put a lot of praise onto the people who picked Amazon for being revolutionary or visionary, but we rarely pause to ask how many of these bets collapsed unseen. Survivorship bias also seduces professionals or even experts. A hedge fund posting double-digit returns for a decade attracts fresh capital, yes, but those returns may reflect simply avoiding the mega crash that ruined other people. When a market shock finally arrives, the manager's strategy, which was celebrated for consistency before, unravels because their models were optimized for bull markets, not bear markets. The public narrative credits expertise, when in truth it is the unremarkable act of not failing which causes people to succeed. To guard against this illusion, Taleb recommends backtesting against an imaginary population of failures. We must ask, for every success that we hold or the success of other people, how many identical strategies actually imploded? Only by reconstructing the silent graveyard of losers or failures can we actually grasp the power of a certain method. We mistake luck for skill and thereby become overconfident. This is how we tell ourselves narratives. Humans are storytelling creatures. We basically weave events into coherent plots with heroes, villains, causes, and effects, yet markets are dictated by events that aren't. When confronted with chaotic data, our mind imposes order by inventing narratives. This is known as the narrative fallacy, our limited ability to look at sequences of facts without weaving an explanation into them. This is of course biological. Information is costly to retain in our minds. It's costly to remember and understand, so the brain naturally starts breaking it down to simpler forms, missing nuance or creating the wrong conclusions along the way. Going over to his next book, The Black Swan, Taleb illustrates how, after any surprising outcome, we retroactively concoct some sort of reason to render it as fate, as inevitable. A stock's sudden surge or gain becomes attributed to strong fundamentals or visionary leadership, explanations that will be articulated months later but would be absent at the moment of the move. In reality, the catalyst may have been a fleeting rumor or some random byproduct of trading. Our stories provide comfort, but they definitely mislead. Fooled by Randomness extends this idea to the trader's self-justifications. After a streak of profitable days, traders or brokers may begin to believe in growth signals, basically movements in the chart that attribute wins to skillful pattern recognition. However, these signals, when under the scrutiny of statistics, shows that these are just rationalizations. The narrative fallacy lies not only in external storytelling, but also in the way that we rationalize things that happened in the past internally to ourselves, mostly to preserve self-esteem. For example, in sports, you definitely heard of the hot hand phenomenon. Fans and commentators will assert that a basketball player is hot because they scored multiple times in a row and they have that confidence of flow. However, when we go through control experiments, the hot hand phenomenon isn't actually real. Each shot's outcome remains independent of the last, so it's an illusion that is a narrative stitched around noise. In financial markets, it also happens around the same way. For example, they steal ideas from fund managers in the past that have gotten hot streaks, they may be unaware that what worked for other fund managers wasn't actually skill and luck, and it's definitely not replicable. The narrative fallacy is dangerous for two reasons. First, it overstates our understanding of complex systems, luring us into a false sense of predictive power. Second, it stifles skepticism. Who would doubt a strategy that makes sense in hindsight but was actually dumb, fundamentally speaking? However, the comfort of stories blinds us to the very randomness we underestimate. This is especially important for those in finance, where we work with risk and modeling in a daily basis. Let's break it down and make things simpler. Imagine a turkey on a farm. Every day, precisely at 9 a.m. and 5 p.m., it's fed. With each passing day, the turkey grows ever more confident that the farmer cares for its welfare. Yet, on the day before Thanksgiving, when the turkey is slaughtered, it seems to be a black swan to the turkey. That action of slaughtering him came out of nowhere from his view. Taleb uses this metaphor to illustrate how stable past performance can disguise structural issues that lead to future poor performance. This is called the turkey problem. The turkey's world is Middle-Christan, as you would call it, domains where extreme deviations are virtually impossible. Financial markets, by comparison, belong to Extremistan, governed by fat tail distributions where rare, high-impact events dominate outcomes. Taleb's lesson is basically this: you cannot infer the architecture of the extremes from the calm of the past. Black swan events, by definition, do not announce themselves. They arrive on their own time, fracturing our previous assumptions. In engineering, for example, stress testing means putting our models through assumptions that have never happened before. In finance, however, we stress test our models through events that have happened in the past, so we are blind to black swans or events that haven't happened before. To summarize, black swan events are large impact events that are both rare and unpredictable, but it depends on the observer's perspective. That last part is crucial. A black swan isn't inherently unknowable, it's a black swan and is unknowable to the people who don't expect it. Going back to the example, a turkey is fed for 1,000 days and expects the pattern to continue. For the turkey, Thanksgiving is a black swan, but for the farmer, it's scheduled and was his original intention all this time. So how did you prepare? You can't really predict the next black swan, but you can build robustness and be sensitive to it. That starts by not asking what will happen, but what could break if something unexpected does from our assumptions.